The Motley Fool, to educate, amuse and enrich.
Hello and welcome to Money Talk, the investing podcast from The Motley Fool. I'm Owen Benelak and my guest today is Gemma Godfrey, Head of Investment Strategy at Brooks Macdonald, the AIM-listed wealth management group. Besides her many years' experience in the city, Gemma has become known as one of the few people who can make finance intelligible to ordinary people, and she frequently appears across the media, from the BBC and CNBC to newspapers like the Financial Times. Gemma was even named as one of the savviest people on Twitter by the Wall Street Journal. Gemma, welcome to the Money Talk studio.
Thank you for having me.
Thanks, Gemma. It's a sunny day in London, so we brought you into here to quiz you in this little studio about various things. And as that kind of half-hearted bit of banter suggested, this is normally the part where I try and put the guest at ease. Normally it's a fund manager who hasn't seen the light of day for a few years. But I actually only do these once a fortnight, and you're frequently in the media, so maybe you have to put me at ease for the podcast.
Happy to do so.
So when you're doing most of those media appearances on CNBC and the like, normally they're asking you about the last 24 hours or so. You know, they're like, Gemma, tell us why this thing happened 30 minutes ago. But I think for this podcast, it would be good if we can sort of step back a bit and think about the bigger global picture. Mm-hmm. And I don't just mean the last 48 hours, just sort of, you know, how someone would invest for maybe several years or their entire strategy, but perhaps in the context of international investing and that kind of global picture and how they might think about that as they go about filling their ISAs or determining their pension strategy and sort of the holistic view, I guess. Does that sound okay?
That sounds right in line with the way that we manage money, so that's great.
Excellent. Okay. And UK investors, obviously, if they put their money into the UK stock market, I think the number is something like 70% of profits come from overseas currently. So a UK investor might think, I don't need to invest overseas at all because they're already benefiting from global trade, from companies like Unilever doing business all over the shop. Are they right to think like that? Or
there are three key reasons why an investor domestically in the UK should still be looking overseas to other investment opportunities when they form a portfolio. And the reason is, first of all, diversification benefit. Having too much money in any one asset, any one sector, any one country provides quite a substantial risk, and the value of their investments can fluctuate quite wildly. Secondly, to get exposure to domestic demand that isn't being served by UK firms. And finally, markets don't always move in line with underlying fundamentals, and it can be affected by the health of the overall economy. So as we do know, UK companies are in a much better state than the UK economy. However, with the economy being fragile, being impacted by Eurozone crisis, Europe is still our largest trading partner, and they're still the largest consumer of our goods, of UK firm goods. Therefore, to enable a portfolio to invest outside of this region should help it longer term in terms of a more consistent return profile.
With the second of your points there where you spoke about domestic issues of an overseas territory, would that be sort of, for instance, in an emerging market where perhaps some of the ways in which it's emerging are not being captured by UK firms? It's things that you could only access via a domestic.
It'll be firms that are focusing, exactly as you're saying, on domestic demand and are much more grassroots in that country, and therefore much more able to exploit the growth of the country than an international firm is. So exactly those type of opportunities you wouldn't be able to get purely via UK companies.
Okay, well, something we should probably mention at the start, which is kind of the unique risk of investing overseas, is currency risk. What is currency risk?
Well, currency risk is when a company does business in multiple countries and the value of their currency will move against each other. So as people know when they go on holiday, let's say somebody's going to Spain 1 year, their euro will stretch. When they buy their euros, it'll stretch a certain amount, and the next year may only buy them 2 beers instead of 3. So you have these fluctuations dependent on the strength of the economy versus each other. And this provides an extra risk on top of investing in the stock market.
And is it necessarily a bad risk? I mean, you could invest in Spanish equities and then the euro could appreciate and then you'd have more of a return. It's sort of, I think when people hear the word risk, they think bad, but risk obviously has return associated with it as well.
You could benefit from it, but because it could also detract, it is something to be aware of. And I think that's something that's very crucial, especially when you're looking at different investments.
Okay, and I think one other kind of risk that we should mention while we're being fearful up here and getting all the caveats out of the way, a hallmark of the kind of post-financial crisis has been another kind of risk, which is political risk, where we've seen governments, central banks, sort of partly determining our fates as investors because of their actions instead of leaving the market to get on with it. Would you say that political risk is another reason to diversify across the globe?
I mean, there are a couple of reasons. First of all, it's incredibly important in terms of diversification to lessen the blow. But regardless of that, even if you feel like you're diversifying the risk, it is incredibly important to monitor. And the reason is that government policy in one country can affect us over here. So at the moment, we're in this era of easing. So the Bank of England have set interest rates quite low and are going out and purchasing, making asset purchases. So they're doing the same thing in the US. Japan have also recently ramped it up. And in that era of easing, where is this money going to? And it can create bubbles and certain pockets that become overinflated in value. So therefore, it's very important to monitor globally what's going on with central bank policy when investing, again, even if you're looking at one specific market.
And what about the politicians, that kind of dimension? Like we saw the Italian political landscape firm up and everything's great there this week for a fortnight.
Yes.
I mean, do we have to, as investors, do we have to be experts in every country's political shenanigans?
It's definitely become more of a challenge. And the reason is over the last few years, the markets have been moving more in line with the rhetoric we're hearing from politicians. So for example, if we look at the European markets, when we had at the beginning a Eurozone debt crisis, the president of the European Central Bank came out and said he will do whatever it takes to support the euro in its current state. And that brought a lot of stability to markets. So things like that, words like that, the rhetoric that are coming out, the action that these politicians are putting into place is currently affecting the stock markets.
So the majority of Brits looking to venture overseas for their holidays probably start where you did with your example of Spain. They look to Europe. Mm-hmm. And similarly, when they invest, probably they think, where's the nearest port of call? Again, Europe probably springs to mind. But political risk, which we've already mentioned, kind of looms large in Europe at the moment. Europe's a massive part of the global economy and you can't shy away from it. So I suppose you have to kind of grin and bear it with all the kind of turmoil that we're seeing there now and make the best of it.
Well, as I've alluded to in the previous question, there seems to be a flaw put in markets by the fact that there is so much political will to support Europe in the state that it's in at the moment. Because the question we always get asked is an exit inevitable? And the way things are at the moment and the way the politicians are acting, they're doing everything they can to keep it together. However, there are still risks that are there. Europe is struggling by growing at two different speeds. You have Germany that's doing very well, and then you have other countries, for example, Spain, Portugal, Ireland, Italy, that are much weaker. And what we need to see is a much closer integration. So yes, it's called the European Union, but it really needs to unite. It needs to unite in terms of its budgets, in terms of the way that the banks work together. There needs to be greater oversight. And finally, we're hearing a lot about bailouts, but there needs to be more assets available there to be able to bail out countries because they're still quite limited.
So if you were a sort of an investor sitting in your house looking at Europe, would you kind of think, I should stay away from Europe until this resolution has resolved itself? Or would you start to put money in now?
What it means is it's becoming more tricky to be very broad with the way you're investing and saying about one region or one country, I'm going to either stay away completely or I'm going to invest wholeheartedly. What it means is there are opportunities in Europe, but you have to be very specific. Again, coming to the point we talked about in the UK in terms of international firms, there are firms that may be headquartered, let's come back to the example of Spain, headquartered in Spain, but most of the revenue they're generating is being generated from sales outside of Spain, so they're more insulated and more protected from domestic woes. Companies like that have strong balance sheets, strong management, are in a very good position and potentially may have been overpunished by this market sentiment. But over the longer term, we're quite confident that their true value will come into play.
Okay, I'd like to get back to Spain soon in the podcast because I've actually bought some Spanish stocks. I want you to reassure me. But you mentioned the sort of the process, the kind of evolving process of how Europe's resolving itself. And it seems we go a couple of steps forward and then we fall down a ditch again. We had all that Cyprus shenanigans, as I'm going to summarize it. When something like that happens, do you anticipate more and more moments like that along the next year or two? They don't change your overall thesis, or do you have to go back to the drawing board and say, okay, now that I've seen this happen in Cyprus, maybe new risks that I wasn't aware of have now manifested themselves?
Cyprus was a game changer. And the reason behind that was the way that Europe was progressing was towards having a greater oversight over the banks and trying to return confidence to markets so depositors would actually come back to these countries and feel safe and secure by putting their money back in these banks. Because what we've seen is them taking their deposits away from the likes of Italy and Spain and putting them instead into Germany and France or even outside of Europe. So the very threat, although it wasn't enacted in the end, but the very threat of hitting small depositors with losses, saying they're going to have this levy on their deposits, goes goes directly against the movements that we'd seen so far towards having guarantees in place saying, it's okay, you're safe to put your money here. We'll guarantee that if there is any turmoil or any trouble, your money will be safe. So what it means is weaker countries are continuing to struggle. Investors are less likely to return their capital to these, we call them periphery, to these periphery countries. And this whole idea of a banking union seems even further away.
And does it also worry you because you think that the politicians should be aware of this? And if they go and do something like that, even if they don't actually enact it, you wonder whether they've really got their hands on the wheel.
Yes, I mean, you are talking about human behaviour and it's obviously very hard to control. And all it takes is one politician speaking slightly out of turn from maybe their party and all of a sudden the markets get spooked. And as we're discussing here, it wasn't finally enacted, but it was the fact that it was discussed and the fact that it was even considered, which gives us cause for concern.
So overall, in one sentence, as if you were on CNBC, would you, are you confident that Europe will sort out its problems and deliver returns for investors in the long term?
Well, progress is being made. There is a flaw in the markets. We just need to see certain progress on key issues in terms of integration, more firepower to be able to protect the different countries in terms of bailouts, and greater reform. And that's also why Italy's been in the press, because we need to see more reform of their labour market so they can become competitive enough. Because the crucial issue so far in Europe has been there has been so much focus on spending cuts that the countries are struggling to get out of recession. So it's hard to give a black and white answer. Things still look quite shaky at the moment, but if we did see progress on these three issues, it would give us greater confidence.
I'm glad you mentioned Italy because I was doing some advanced technical analysis the other day where I was looking at a graph of the Italian stock market over 10 years and I was noticing it was down an awful lot. And so obviously that suggested to me that potentially there was some opportunity there. Those countries, if you look at them from, say, a price to book value, in terms of what are the assets worth and what are you paying for them, Spain is similarly. You do seem to be, getting quite a lot for your money. Is there a chance that because the pessimism is so great in those countries and there is such scope for reform that this could be, a transformational moment where at the moment it seems very doomy and gloomy, but because you're not paying too much, if you can park your money away and wait for 10 years and maybe some of those reforms come through, the animal spirits of capitalism are unleashed, that you could see perhaps an outsized return compared to, say, the US where things look obviously a lot better?
That's actually a very interesting point. And the reason is we made the call last autumn that the US markets hitting all-time highs seem to be potentially overstretched, whereas in Europe, potentially overpunished. And therefore, we did decide to take profits in the US and reallocate some of our investments into Europe. The word of warning I would say, though, is that investments can go down to zero. I mean, they rarely do, but there is a still potential loss if there is further turmoil. So therefore, the way that we gained exposure is through high quality assets. If you're investing in a company that you do have faith is going to be adding value, increasing their profits, increasing their bottom line over the longer term, you have that extra layer of confidence in terms of where you're placing your money.
And quite often, if you're buying a company in Spain, say, you could be getting incredible exposure to South America. And if you buy the same sort of exposure in the US, you're paying a lot more for the same fundamental thesis.
Yes.
So in general, the US, it does look like it is going to be the first major developed economy to kind of forget about 2008 and push on with the bold 21st century and all the success we hope it will bring. Its market certainly seems to think that. You've mentioned that you thought maybe last year things got a bit ahead of themselves. We've seen then a big rally at the start of the year in the US. It seems to have petered off a little bit now. In general, do you think that the US is looking a bit frothy and possibly there are better opportunities around the world, or do you think it's better to sort of back the proven winner?
The US economy is doing far better than Europe and the UK. We're looking at approximately 2% growth, whereas obviously in Europe and in the UK actually we're trying to avoid recession. So economically is in a far stronger position. However, if we turn to markets, the fact that it has posted all-time highs in the face of weak labour market, $85 billion of spending cuts, which is going to really hit its consumption level, it does mean that we took the opportunity to profit take. I mean, we still have a significant exposure to the area, but exactly as you said, in times when you think markets are potentially overstretched, is a good opportunity to review where the other opportunities lie.
I mean, if you look at the US in the long term, leaving aside the valuation, it does seem to, be quite blessed suddenly again. It's got this cheap energy now that its natural gas prices have collapsed. There's talk of it becoming a new manufacturing powerhouse because it can now compete effectively with countries like China. And demographically, it still has a lot of people moving to the US for everything that they hope it will bring, sometimes legally and sometimes not, but possibly that will even be resolved. Those populations tend to be more fertile, younger population as a result. In the long term, the US still looks like a pretty strong economy and a good place to have your money. That's not even mentioning the amazing companies it has that stride the world.
Well, crucially, the government was early and aggressive aggressive in the way that they tackled the financial crisis. And because of that, they've been able to recover a lot quicker. The recovery is still fragile. As I mentioned before, the labour market, unemployment is still a significant headwind. Households are looking at deleveraging, and there is going to be this debate over the debt ceiling. So there are a number of reasons to be cautious over the shorter term. But in terms of the strength of their corporate balance sheets have historically high levels of cash. So the amount of firepower that they have to be able to implement in terms of hiring more people, expanding their production is quite impressive.
You mentioned that the US were kind of quick off the bat to sort problems out. Turning to a country which was in the tea house, sort of drinking extra tea. I don't know what the cricket analogy is. My sporting knowledge is showing itself. I'm thinking of Japan, where there didn't seem to be any great rush to sort anything out, where that attitude seemed to extend for a couple of decades. Finally, they've got someone in who's going full on with the printing presses, because it's been a country that's just been in deflation for years, hasn't it? And if you have deflation, you don't bother investing. You can just save your money in cash because things get cheaper. There's not exactly any incentive to go out and try and make your way in the world. Do you think that Japanese companies, as they see inflation kind of reignite at home and they see themselves in a more competitive position worldwide, will be able to finally shrug off what is it, 3 decades of a bear market effectively? It was 1989, I think, the Nikkei peaked. So
Japan is the hot topic at the moment, and the reason is it's been unloved for such a long time, and Japanese bulls have been ringing the case for so long in terms of valuation, the fact that the market's so cheap. But crucially, we've always been waiting for a catalyst, and the catalyst at the moment is the fact that the government is going to be targeting inflation, which should boost consumption, because the attitude previously is, well, why would I buy now? It's only going to get cheaper. If you all of a sudden get inflation, it's, well, you have to buy now before the price goes up. So not only will it boost consumption, but also it's going to create a weaker yen. They're also targeting a weaker yen, which means that it's going to be supportive for margins, which is important in a low growth environment, that they'll still be able to post attractive returns. So it is an area that we're looking at, and we are starting to get a bit more excited about in terms of good quality exporters, maybe even in the mid and the small cap areas, which, because the country has been so unloved, has really been underbrokered. There's definitely the potential there for interesting returns.
it is interesting when you look at funds over the years. In the late 80s, there were several dozen Japanese-focused funds, and then every year there's been fewer and fewer and fewer, which is kind of a good contrarian indicator, perhaps, as you say, that people have shunned the market. Flipping that round, if we'd had you in a couple of years ago, I think we would have been banging the table and saying, Gemma, tell us about emerging markets. But they've kind of dragged their feet in the last couple of years. Why do you think that divergence has happened? Do you think it's possibly the opposite happened? People got too carried away with themselves, or have emerging markets stopped emerging?
Well, they haven't decoupled economically, and that's what everybody was waiting for. So in times when the US and Europe and the UK are slowing down, there aren't as many consumers that are going out and buying their products, because what people often forget is that an emerging market company may be selling wholly outside of their area, and so to developed markets. So in that respect, they have been significantly hit by the financial crisis. If we look at Latin America, there have been structural inefficiencies. So Brazil, for example, grew by only 0.9% last year. However, you can contrast that by the more dynamic export-led Chile and Peru. So again, the nuances within the area has become a little bit more stark. There have been rising labour costs, inflation, and the Chinese recovery has proven to be slightly more fragile. However, we are still looking at China growing at around 7.5%. So it does have to be put into context.
I mean, stepping back and looking at, say, the next 20 years, because it's not enough for you to predict the next year, Gemma, what 20 years. Do you think that, we're going to be looking at a world where these emerging markets are seen almost as no longer emerging markets? They're like South Korea or or even Japan, I guess, countries that we just think of as part of the global developed economy. And if so, does that mean that the argument that this is where you really should have your money for the highest returns still holds?
Well, if we look over the longer term, funnily enough, it is actually that the dynamics are clearer. 1 billion, it's estimated that about 1 billion of the population are going to be joining the consumer class in emerging markets. And actually the Chinese middle class is going to exceed the entire population of the US within a few years. So the dynamics are quite obvious, and this is going to be a very interesting place to be over the longer term. China has been aggressive and early in the way that it dealt with the problems, and the reforms that the new leadership are implementing is focusing on increasing domestic demand. So as you said, the dynamics very naturally are going to be putting these countries in a very strong position, and therefore we're looking, as we said, actually valuations are looking quite attractive. We're looking to these areas in terms of investment.
If you had to take the Godfrey fortune and put it on one country, is there one particular emerging market that you think that's the one for me? Or is it just too risky to say Brazil versus China?
I would never put the Godfrey fortune on one particular country.
So spread it around a bit.
Yeah, diversification is key.
I mean, it's interesting that we heard a lot about the BRICS 5 or 6 years ago, and then they started talking about, I don't even know what some of these mean, but CIVET,
Yeah.
MIST. There was a jokey one, which I can't remember the acronym now, which was pretty much all the emerging markets that aren't covered by an acronym. Do you think that as private investors, we have to kind of be wary about, and I'm aware I'm speaking to a financial services firm representative here, but perhaps be wary of the kind of hype that might be almost manufactured around a particular way of defining what's a longer term story?
Well, the reason why people are starting to look a little bit further out is we are in a low return environment and it is getting tougher to meet certain return targets. However, it must be acknowledged that with the opportunity to gain greater upside comes greater risk. And these are countries where there is even greater political risk.
So in general, these CIVETs and MISTs and whatnot, these are kind of frontier markets.
Exactly.
They're beyond the emerging markets, the sort of Wild West.
Wild West might be slightly too, I guess, aggressive a term for some of the countries. Again, that's why I'm always hesitant in grouping countries together, because as you pointed out, in one case, they were only grouped together because they weren't already grouped together. And actually, there can be significantly different nuances and different ways of playing it and different ways of gaining exposure. So I would be looking at it much more specifically on a case-by-case and investment perspective.
And do you think that's a time when you need to find an expert fund manager?
Definitely.
Because they're on the ground.
Definitely.
Okay, so what's your kind of overall take then, just to sort of round things off, on the global economy and perhaps the stock market, because that's where we hope to make our fortunes? Do you think this bull market, which is actually a bull market, has been going on for sort of 4 years to the sort of astonishment of everyone, do you think it can continue like it did in the 80s and the 90s? Or do you think either the economic background is just too miserable, or perhaps that the valuations were, not beaten down enough at the start for it to really roar on until 2020, 2025? I mean, what's your kind of overall gut feel?
We feel that the stock market is the place to be over the longer term, but we also acknowledge that there could be potential potholes causing swings in markets over the shorter term. So we've seen an unprecedented amount of government support, and markets have been led quite a lot by optimism as opposed to fundamentals. So what we need to see now for the next leg up is growth, and obviously growth is elusive. But as I alluded to, the governments are remaining very supportive. It's hard to extract yield in the bond markets anymore. So with cash giving you nothing, sometimes negative yields, bond opportunities being even more scarce, whereas dividend yielding stocks, for example, can provide you with quite an attractive income yield. Stocks are the place that we feel more confident with, as long as you acknowledge that there may be bumps along the road from, again, more turmoil in Europe, the US debt ceiling negotiations, Chinese policy, etc.
I'm putting you on the spot a bit here, but I've just sort of realised that we didn't talk about how much you should invest overseas in terms of your overall portfolio. I mean, is it, some people seem to think they've got 10% overseas and that's enough. And then if you look at the global economy, it would be something like 90% of the economic activity, or 95 perhaps happens outside of the UK. So do you have a sort of rough ballpark figures at all?
And we try to stay quite flexible and quite dynamic in terms of the different economic environment. So we do work within bands, and the key is, as you said, is to have a genuinely diversified portfolio as opposed to having a couple of percent here, a couple of percent there, and thinking that that's going to be balancing out. However, it's hard to put a number because the environment is obviously changing, and at times when it changes, it's appropriate to change your investment policy.
Okay, that's great, Gemma. Now, you appear all over the media, and you've probably never seen a broadcast end with a quote, but that's what we do here for some quaint reason. And many of our listeners have probably heard that you're a nuclear physicist by training. Got to the end of the podcast without mentioning that. It's usually up the top. So I'm going to quote, well, this quote is attributed to Richard Feynman, the American physicist. I'm not sure he actually said it, but apparently he said, "If you think you understand quantum mechanics, then you don't understand quantum mechanics." And I think you could say the same thing about investing and perhaps some of these overseas themes even. If you look at them on the surface and go, "I understand that immediately," then you probably don't. You're probably fooling yourself.
I completely agree. Yeah. Good quote. I like that little tie-in. It's great.
It's clever, isn't it? I've had 2 weeks to work on it. Okay, so Gemma, I'm also going to mention to listeners that if they want more of your insights, they can follow you on Twitter, where you are the savviest person, or one of the savviest people, Wall Street Journal confirms, and they can follow you at GC Godfrey, which is Godfrey. So it's at GC Godfrey at Twitter, and you can follow Gemma there without me intervening in between. So thanks for coming in, Gemma.
Thank you for having me.
And thanks to all you guys for listening, and we'll see you next time.